What is the difference between an index fund, a mutual fund, and an ETF? Well, in today's video, I'm going to be going over these three things and the differences that they have, but also the pros and cons in each. We always hear these three different terms get thrown around when it comes to investing. But do you actually know the difference? Most people don't. Most people don't even know what these are. And I'm going to be honest, I got my bachelor's and my MBA with an emphasis in finance, and if it wasn't for taking investment classes, I probably never even would have learned it. And when you are investing in something, you're going to want to know what they actually are so that you don't have to have a headache in the future trying to fix the decisions that you make today by changing your investment strategy completely. And in today's video, I'm going to be going over everything I've learned so that you can be most informed about your investment strategy when it comes to the differences in index funds, mutual funds, and ETFs. So if you want to know more about these three things to set up your strategic strategy in investing, then stick around. Before we go on though, guys, hit that subscribe button so that you can be set up to learn all the information about all the stock market, finances, and just really making money and setting yourself up for future success. So the first one I'm going to be talking about is mutual funds. And the reason I'm going to be talking about mutual funds first is because they're the oldest. And mutual funds were created so that investors could just pool their money together and then make investments together. These investments can be stocks, bonds, short-term debt, you name it. But basically, when you actually invest in a mutual fund, you are buying a proportional share of that fund since it's a lot of people's money all together. When you invest in a mutual fund, it is very convenient. And the reason it's convenient is because you're actually investing in a bunch of different stocks, bonds, or short-term debt all in one location. It's all in one centralized location, and you don't actually have to go to all these different companies to buy their stocks or bonds. So it's all in one centralized location. And another convenient part is you actually have a mutual fund manager. So mutual funds are convenient because you're actually buying all these stocks that are in this one fund all in a single click of a button. You also have a manager, so it's a pretty passive investment strategy since the fund manager is actually going out and picking and choosing what are in these funds. They also usually have a lot lower risk because not all your eggs are in a single basket. Now, you are at the risk of your fund manager actually picking funds for you, picking these stocks and actually investing for you, so you got to be able to trust your fund manager. But if you trust your fund manager and you think that they're going to do a good job, you kind of just pay the price of the fund. You buy your proportional share of the actual mutual fund, and then you just sit back, relax, and hopefully he gets you a really good return in the markets. So having a manager, a mutual fund manager, is actually a pro to this type of fund. And the reason it's a pro is because, like I said, you get to sit back and be passive while he actually makes the investments for you. But there's a con that also comes with a fund manager, and that is that you're actually going to have to be paying a fee. Usually this fee to the manager is actually a 1% to 3% fee every single year. So, for example, say you want to invest $10,000 into a mutual fund, and so you give your money to this mutual fund, and this manager takes 1% to 3% per year. That means that they are instantly taking $100 to $300 straight off the top. Just instantly takes $100 to $300, and you pay this no matter if they make you money or lose you money. And that's why I'm saying this is a con, because it does have a high fee compared to other types of investment strategies that you can actually do, and I'll be getting into those pretty soon. So that is probably the biggest con in my eyes, is the fees that come with actually being invested in a mutual fund, because you could actually lose money from where you actually start. And that extra fee, though, that 1% to 3% per year, If you actually do that on a calculator and you're invested in mutual funds for say 40 years, that could end up costing you hundreds of thousands, if not millions of dollars, depending on how much you're actually investing into these funds. So if you aren't okay with high fees, then I would probably avoid mutual funds. But now I want to talk about the second one, and that is index funds. Now, index funds are different than mutual funds because they are a passive investment strategy. And what I mean by that is when you're investing in a mutual fund, it's actually an active investment strategy, even though your side is passive because you're not actually picking and choosing the stocks or bonds. It's a passive investment strategy for a index fund because there's no fund manager actively changing anything. They're not buying and selling stock. They're not doing anything. An index fund is actually mirroring or watching and trading the indexes in the market. An index fund uses a fixed formula that completely eliminates the purpose of a manager buying and selling. And actually, the formula follows an index, which is where index fund came from. And the purpose of the index fund was to actually get rid of the fund manager because people were tired of paying 1 to 3% and losing a ton of money. Like I said, hundreds of thousands of dollars over the course of their life just to managers. So they use this formula, it tracks these indexes basically, and then it invests and has a portfolio in that index exactly like what it wants. And an index is a tool that basically just quickly measures the stock's performance over time. And so the first index fund that was actually created was for the S&P 500. The S&P 500 is the United States 500 biggest stocks. So simply put, whatever the S&P 500 has in it, this index buys it. And so it buys these stocks and puts them in the index. So whatever the S&P 500 is tracking, that index says, I'm going to do the exact same. And so if you're invested in that, it does that for you. And since it's doing it for you, you would expect that you have to pay this high fee because you're not doing it. But that's the best thing about index funds is that you don't actually pay this high fee. It's a super low fee. And so for example, the Vanguard S&P 500 index fund charges a 0.04% fee every single year, which is nothing compared to 1, 2, 3% per year. And when you actually invest in an index fund, say you're on Vanguard, it will say index fund. Right in the description, it says index fund, meaning that you know that it is actually just tracking these indexes and doing exactly what they're doing. So say you want to invest in a certain fund, look at the name. And if it's not in the name, look in the principal investment strategies, and it'll actually say this investment follows an index of the S&P 500. So that's just an example. But if it's not, it'll say something about this investment has an independent advisor, which means it's a mutual fund, and those fees are also going to be higher, like I said. So that's another way that you can see if it's an index fund or a mutual fund. Usually it's just by how much they're actually charging in fees. But if not, look for the name and look in that principal investment strategies and actually see where how that fund is actually buying. If it says index, then usually it's an index fund. If it says an individual advisor or something like that, then usually it's a mutual fund. So that's the difference basically in a mutual fund and an index fund. They're very similar. They both are investing in hundreds of stocks, bonds, or whatever at the exact same time, but one has an active manager and one is a passive manager, meaning it's just following those stocks, following those indexes, and buying exactly what those indexes have in it, compared to an actual person, an actual advisor that is buying and selling in that portfolio for you. So now what is an ETF, or an exchange traded fund? Basically, ETFs and index funds are very similar, but there's just a few things that they do differently. So an ETF, like I said, is very similar to an index fund, except one big difference is that an index fund can only be bought or sold once per day. And when I say once per day, it's actually at the end of the day. That's when the transactions actually go through, or at the end of the day. ETFs, though, are traded like stocks. They're not stocks. They are a fund that has hundreds of different stocks in them, but you can actually actively trade them throughout the entire day that the markets are open. So with that being said, if you're asking yourself, should I invest in an index fund or an ETF? Because in my opinion, those are the better options if you don't want to get hit with those mutual fund fees. So do you need to have the 24/7 tradability to actually buy and sell your investments? Most people, I would say most people do not need that. Why do you need to actively trade your investments? If you are in it for the long run, if you are in it for investing, then you would want to go with an index fund. If you are in it for trading is completely different than investing, because now you are actually looking for buying and selling opportunities throughout the entire day that the markets are open. That is trading compared to investing. Trading to me is short term, investing is long term. And so if you need short term for whatever reason, then ETFs would be the better path for you. And if you need long term, then I think index fund is for you. So most people, like I said, index fund is the best choice for you. So you're avoiding the fees and you're investing long term. You don't need the 24/7 capabilities of actually trading. Now, I personally enjoy both. I like investing in index funds for the long term. If my goal is to invest in the long term, which I have portfolios that are like that, then I want to be investing in index funds. I also have some ETFs, but that's because I also like to do the trading. I like to be an active investor. I like researching. I like doing all that fun stuff. And so I do have a little bit of that. But I would say if you're a long-term investor or you're buying and holding for retirement or long-term, index funds are the best choice for you. Another huge thing when it comes to index funds or ETF is index funds, you can actually have a reinvestment strategy where you set up your bank account and every single month it pulls money from your bank account and invests in more index funds for you. ETFs, you cannot do that. ETFs mean that you have to manually go in every single month and invest it by yourself. And the cool thing about that for index funds, about it reinvesting automatically for you, is it is no extra charge. And so if you are really looking for investing where you are consistent investing, you're dedicated, and you just want that automatic reinvestment, then an index fund is for you because it has low fees, it automatic reinvests, and you can set it up to where it does it for you. Plus, you're diversified over all these different stocks that are in these funds. So that would be the best choice for you. If you are okay with having to go in and invest it every single month manually, ETFs could be the way to go for you, because you'd have the 24/7 tradability, and then you'd have to go in and do that. But for most people, that is not how they need to invest. They need to pay themselves first. And if you make it automatic, most people won't even know that it's getting taken out. And even if they do, it's good for you because you're investing for your future. So that's basically it. Mutual funds were created so that investors could pool their money together to invest together. They are ran by active managers who actually charge a 1 to 3% fee. Investors did not like the 1 to 3% fee, so they had index funds created at a much lower fee. And index funds are automatically reinvestment strategies, and they can only be bought or sold at one time per day at the end of the day. So some investors didn't like that. They said, hey, let's create ETFs that trade like stocks, but there's no automatic reinvestment. And so that is the difference between a mutual fund, index fund, and ETF. I want to know down in the comment section which one you like best and which one you would most likely invest in if you haven't already. Is it a mutual fund? Is it an ETF? And is it an index fund? And also drop below, what is the best ones to invest in? Is it SPY? Is it VOO? Is it any of those? Just tell me below what you actually invest in. Share this with a family member so that they can know the difference between these 3 investment strategies, and who knows, maybe you will be the one to change their life since they watch this video and actually get them to invest to set up for their financial success. Until then, guys, remember, you can do all things through Him that give you strength. Peace.